Welcome to my YouTube channel Equityverse. Today we are diving deep into one of the most fundamental questions in investing. Why do stock prices constantly fluctuate? Let us go beyond the simple supply and demand concept and explore the real mechanism, psychological forces and market that make prices dance every single day. Today's topic is why stock prices go up and down every day, the real story behind Indian market movements. Let us start the foundation. Let us start from understanding the Indian order book battle. What is Indian order book battle? Every day when you have opened your screen of your computer or terminal, observe the NSE trading terminal at 9:15 a.m. in the morning. For every stock, there is an individual war happening in the order book. On one side, buyers placing bids; on the other hand, sellers pricing offers. That is also called asks. The last traded price is simply when these two forces last agreed. There is trade-off between these two bids and asks. From a real example, taking from Reliance Industries on a random trading day, any day, 9:15 a.m. pre-open. The price of Reliance Industries 2,845.50, and 9:30 a.m. market opens. When market opens, that price is 2,848.20. There is up 2.70 rupees. Then 9:45 a.m. the price ups 2,852.8. There is up plus 4.6 rupees. At 10 a.m. 2,846.3, there is minus 6.50. What is these signals? What we are observing these data? Nothing fundamental change about Reliance business in these 45 minutes. In these 45 minutes from 9:15 a.m. to 10 a.m. then nothing change in Reliance business, but the balance between buyers, bulls and sellers, bears, that is called shifted constantly, creating these price movements. These two factors, buyers and sellers, bulls and bears, shifted constantly, creating these price movements. There are five real forces that move Indian stock daily. First is foreign institutional investors, that is FII, and domestic institutional investors, that is DIE flows. These two main factors. This is the biggest daily driver unique to Indian markets. Every day at 3:30 p.m. NSE releases provisional FI DI data, and this single number can move the entire market. What is the impact? That is mathematical impacts. When FII, foreign institutional investor, pump in rupees 5,000 crore in a single day, they are not just buying stocks, they are creating a ripple effect in the stock market, like pond, a stone throwing in the pond, the ripple effect. Direct buying pressure on large cap stocks, supporting the rupee, less dollars leaving, boosting market sentiments, triggering algorithm buy programs. From simple case study, data is from August 2024, the FI selling tsunami. Context: US Federal Reserve hawkish signals a strong dollar. The numbers are August 1 to 15. AFI sold rupees 25,000 crores plus. Nifty and Nifty 50 dropped from from 24,800 to 24,100. There is sharp down minus 700 points. That is downgrade 3%. Bank Nifty fell from 51,200 to 49,500. There is sharp downfall minus 700 points. That is 3.3%. But here is what happened simultaneously. DI bought At the same time, DI bought rupees 28,000 crore, offsetting FI selling. Stock still fell due to FI activity in for future and option, creating additional pressure. Mid cap and small cap stocks fell harder, 8 to 12%, because DI focused on large cap. DI focused on large cap. So mid cap and small cap stocks fell harder. Now, what is the impact of individual stock like Infosys? August 1. The market price is 1,580. Now 15 August 1,465. There is sharp downfall, minus 7.3%. No company has specific bad news. There is no bad news about Infosys. Pure FI selling in IT sector. This is the factor. This pattern repeats almost weekly in Indian markets. Check any sharp market move, you will find FI DI data behind it. Second factor is the rupee dollar dance and its daily impact. Indian markets are uniquely sensitive to currency movements because we are a net importing economy with significant foreign investments. How it works? Suppose 1 rupees depreciation against the dollar, different impacts on different stocks. How? BC winners. Export heavy companies are winners. IT companies like TCS, Infosys, HCL Tech. Pharmaceuticals, Dr. Reddy's, Sun Pharma. Textile exporters. But who are losers? Import heavy companies are losers. Oil marketing companies, BPCL, HPCL, if they cannot pass cost. Airlines, Indigo, SpiceJet, paints and chemicals, high import content. Real examples are October 2024 current impact. On October 15, rupee closes at 83.25 per dollar. October 22, rupee weakens to 83.85. There is 0.7% depreciation. Same week, stock movements. TCS 2.3%. The export heavy companies winners. Rupees 3,650 to 3,734. Infosys they gain 2.1% plus. Rupees 1,485 to rupees 116. Indigo is import heavy companies. The fills minus 1.8%. 3,240 to 3,182. BPCL minus 2.2%. 585 to 572. No major company specific news in the market. Rupee movement alone created this divergence. The intraday correlation was this pattern. When US dollar and Indian rupee spikes during trading hours, IT stocks instantly jump. This happens because algo traders. What algo traders? Algo traders use computer programs which with predefined rules, algorithms to automatically execute trades in financial markets, removing human emotion and enabling faster, more frequent orders based on price, volume or time, using a strategy tested on historical data for efficiency and scalability in equities, futures and options, programmed to exploit this correlation. Intraday correlation with the help of algo traders. This is programmed to exploit this correlation. I hope you understand what is algo traders. FI hedge currency exposure. Traders round up expected volumes. Third factor is algorithm trading and the new market reality. There is shocking statistic. Over 50% of NSE trading volume comes from algorithms, not human decisions. Here is the main factor: algorithms. A SEBI data shows algo trading accounts for 8 to 10 lakh crores daily turnover. The three types of algo dominating Indian markets. What are? High frequency trading (HFT) algos. These execute thousands of trades per second, exploiting microsecond price differences between NSE and BSE and between cash and futures. The real impact on the trade. On March 14, 2024, between 2:15 p.m. to 2:18 p.m. in just 3 minutes, HDFC Bank saw 45,000 trades. Price oscillated between rupees 1652.3 and 1653.8. Price oscillation between these two values. Total of rupees 850 crores traded. Net price change only 0.4%, 0.4 rupees. This was not fundamental analysis. This was algos battling each other, creating liquidity but also noise. This is the amicable remarks. Creating liquidity but also noise. New based algos are these scan new feeds, social media and even company announcements in milliseconds, executing trades before humans can read the headlines. This can be understood from case study. Adani Group New January 2023, when Hindenburg Research released their report. 10:30 a.m. report published online. 10:33 a.m. First algo sales detected 3 seconds later, and 3:30 and 10:30 a.m. massive selling pressure builds, and 10:32 a.m. circuit breakers hit on multiple Adani stocks, and 10:35 a.m. most retailer investors still reading the report. This is arbitrage algos. Third one is arbitrage algos. This exploit price differences between cash and markets, NSE and BSE, index futures and individual stock futures, Indian ADRs and local stocks. Arbitrage. This is the main factor when the traders can make money between two market, cash and future markets, NSE and BSE, index futures and individual stock futures, Indian ADRs and local stocks. For example, if Reliance trades at rupees 2,850 on NSE and rupees 2,852 on BSE, algos instantly buy on NSE and sell on BSE. Book rupees 2 profit per share. Repeat thousands of times per day. This creates those sudden 0.1% jumps you see for no apparent reasons. There is no apparent reason, but this create there is arbitrage. The Indian trading day pattern, circuit to circuit. Indian markets have unique characteristics that create predictable intraday patterns. The sacred trading timeline. Fourth factor is Indian trading day pattern, circuit to circuit. They create this is a unique characteristics of the Indian market that create predictable intraday patterns. The sacred trading timeline 9 to 9:15 a.m. pre-open session. Orders accumulate overnight. Equilibrium price discovery. Open gaps up and down based on global cues. Retail investors panic and celebrate based on opening. At 9:15 a.m. the opening bell chaws. This 15-minute window sees the wildest swings. Case study budget day 2024 February 1. Let us analyze this. FMCG stocks pattern on budget day. At 9:14 a.m. pre-open ITC at rupees 442. At 9:15 a.m. no major FMG announcements in budgets. 9:16 a.m. ITC drops to rupees 438. Panic selling. 9:25 a.m. rises to rupees 445. Smart money buying the dip. At 9:45 a.m. settles at rupees 443. Nothing changed in those 30 minutes except trader emotions. At 10 a.m. to 2:30, the lull. Professional traders dominating. Retail participation drops. Tighter price ranges. True price discovery happens. 2:30 3:30 p.m. Power hour Indian style. This is when the real action happens in India. This is the time when the real action happens in India. FIs place bulk orders. Mutual funds rebalances. Traders square off positions before close. Maximum volatility return. This is the main time. Power hour in Indian style. Real pattern Nifty 50 December on December 5 2024. We look at the pattern 2:30 p.m. 24,350 2:45 p.m. 24,320 minus 30 points. Selling pressure. It was selling pressure. 3 p.m. to 3 p.m. to 24,380. There is 60 points upward. DI buying. And 3:20 p.m. to 24,410. There is plus 30 points. Short covering. And closing strong 3:30 p.m. 24,424. The last hour moved 105 points 0.43% with zero news. These were purely institutional games and positioning squads. The only game played by FI and there is fifth reason factor global market correlation. When India sneezes because the US catches cold, it means India sneezes. Kyun? Why? US catches cold. Indian markets do not trade in isolation. We are deeply connected to global flow, especially US markets. Indian stock market is connected, especially US markets. This is the same. This is true. India sneezes when US catches cold. The overnight impact formula: US market close 6:30 a.m. IST. Indian markets open 9:15 a.m. IST. There is 2.75 hours gap. Creates predictable patterns. Correlation strength: Dow Jones and S&P 500 movement 60-70% correlated with Nifty opening. Nasdaq movement 7 to 80% correlated with Nifty IT opening. Crude oil movement direct impact on oil and gas auto sectors. When US Fed rate decision December 2024 on 18th December 2024 at 10:30 p.m. IST December 18 US Fed announces 25 basis points rate cut but hawkish commentary. US market reaction: Dow drops 2.5%, Nasdaq falls 3.6%. SGS Nifty overnight falls from 24,200 to 23,850. There is minus 350 points downfall. Next day on December 19, what happened? 9:15 a.m. Nifty opens at 23,900, gap down 300 points. At 9:30 a.m. falls further to 23,750. On the what impact on sector? IT stocks minus 4% downward. Infosys, TCS, Wipro hammered. Auto minus 3%. Global slowdown fears. PSU banks minus 2.5%. Defensive lag FMGC only minus 0.5%. What is the reason? No India specific needs, pure global contagion. The China factor also included. Increasingly Chinese market also impact India, especially in commodities, steel and copper, chemicals and FI, solar equipment and companies. When China Evergrande crisis deepened in September 2023, Indian real estate stocks fell 5 to 8%. Cement stocks dropped 3 to 4%. Fear of global contagion, even though Indian real estate fundamentals were strong. The hidden Indian players moving markets. Operators and operators stocks. What is this? These operators and operators stocks. Let us address the elephant in the room. Stock manipulation exists in Indian market, especially in small and mid-cap stocks. How operator works? Step 1, accumulation. Quarterly buy 10 to 15% stake over weeks through multiple accounts. Step 2, create wedge. Paid tips on Telegram, WhatsApp group, YouTube channels. Step 3, price manipulation. Place large buy orders to create artificial demand. Step 4, distribution. Sell accumulated stock to real investor who bought the hype. Step 5, cracks. Remove support. Stock crashes 30 to 50%. This is happening in Indian market. Real example pattern. Composite of multiple cases. A small cap pharma stock in January trading at 45 rupees. Operator accumulates. February tips start circulating about big contract news. In March 15, stock jumps to rupees 72. There is 60% up on rumors. March 20, operator selling begins. April 15, stock back to 50. Retail investor holding losses. Now comes into picture SEBI. SEBI has taken action in 2023-24. SEBI banned over 150 entities from markets for price manipulation. Red flags to watch. Investors must watch the red flags. If there is sudden volume spikes 10 times normal with no news, stock rises on expected news that never materializes. Concentrated ownership, promoter plus few entities holding 70% plus. Unusual call put option activity. These are the scenes we have to watch for red flags to alert in investing. Future options. The tail wagging the dog. India has one of the world's largest retail future options market. NSE future option turnover 500 lakh crores monthly. The future and options market on cash markets. Every Thursday weekly expiry, Friday monthly expiry. Every Thursday weekly, that is expiry, and Friday monthly expiry. You see wild movements driven purely by derivatives, not fundamentals. We have taken case study for Nifty expiry day, December 28, 2024. Context Nifty trading around 24,400, maximum open interest at 24,500, strike both calls and puts. The expiry day drama was happened 2 p.m. Nifty at 24,420. At 2:30 p.m. sudden buying rises to 24,480. There is 60 upward. At 3 p.m. intense volatility swings between 24,460 to 24,520. 3:15 p.m. pin exactly at 24,500. At 3:30 p.m. closes at 24,498. This was not coincidence. Market makers and large traders pushed it toward 24,500, where maximum options would expire worthless, benefiting options sellers. Individual stocks example: HDFC Bank weekly options. Last Thursday before monthly expiry, stock was at 1,675 rupees. Massive call writing at rupees 1,680. Massive put writing at 1,670. Stock magically closes between 1,627 to 1,678 for 3 consecutive days. Both call and put writers profit. From this mechanism, under this game, both call and put writers gain profit. The delivery data script. The check and AC delivery percentage data. High delivery percentage 60-80%. Genuine buying and selling. Low delivery percentage 15 to 30%. Speculation and future option hedging. The stock might move 5% on low delivery, temporary, likely to reverse. Mutual fund inflows and SIP impact. Here is uniquely Indian phenomena. 20,000 rupees per crore monthly SIP inflows creating persistent buying pressure. See, SIP inflow also made impact on Indian market. See, SIP calendar effect. Most SIP is quit between 1st to 10th of the every month. This creates observed pattern. November 2024. We have taken this pattern. November 1 to 7, Nifty rises from 24,100 to 20 to 20 24,100 to 24,550. There is 450 points upward. November 8 to 20, consolidation, minor correction to 24,350. Now between November 21 to 30, recovery attempt. Why? Mutual fund deploying 18,000 to 20,000 crores as SIP money creates systematic buying in large and mid caps. Sector rotation impact when mutual funds shift allocation. In 2022-23, heavy allocation to IT and FMCG defensives. 2023-24, rotation to PSU banks, defense, infra. Individual stocks in favored sectors get 3 to 5% boost purely from MF flow. Case study: PSU Bank rally 2023 and 24. SBI stock journey. In April 2023, stock buzz of SBI was rupees 545. December 2023, this was 625. There was 14.7% upward. March 2024, the 735 rupees. There was 17.6% upward. What is the driver of upwarding this market price? Mutual funds increased PSU bank allocation from 4% to 8.5% of equity and asset under management. That 40,000 crore flow created sustained buying pressure. Fourth is IPO and block deal calendar. Major corporate actions create daily volatility. IPO impact pattern. What is the IPO pattern? Impact. Pre-IPO, anchor investors buying, peer companies rally, sentiment boost. Example, when Zomato listed in 2021, Swiggy unlisted, valuation jumped. Nykaa IPO got oversubscribed, platform company euphoria. Flood food delivery ecosystem, stocks benefited. Post listing, often 20 to 30% correction in first 3 months as anchor lock-in expires. Block deals impact. When promoters or large investors sell blocks, real example, Vedanta promoters sell. August 2024 news. Vedanta promoters selling 3% stake via block deals. Stock reaction -4% in a single day. Fundamental change 0. Ownership change does not affect operations. Market psychology, promoter knows something we do not. QIP, qualified institutional placement dilution. When companies raise money via qualified institutional placement, stock typically falls 3 to 7% on announcement due to share dilution. What is share dilution? Share dilution occurs when a company issues more shares, reducing existing shareholders' ownership percentage and control, often to raise capital. Pay debt or reward implies, but it can be positive if company grows significantly, making their smaller stake more valuable, a larger slice of a bigger pie. It happens through new stock sales, IPO, secondary offerings, imply stock options, or convertible securities. While it lowers the percentage stake, good dilution can increase overall company value, benefiting all shareholders long term. A second one, sentiment that company needs money. Is growth slowing? Lock-in period creating overhang. The emotional psychological drivers in India. WhatsApp and Telegram group frenzy. Unlike Western markets, India has unique information dissemination through WhatsApp group and Telegram and YouTube channels. 10,000 stock tip WhatsApp groups daily. Telegram channels with short multi-bagger calls. YouTube channels create with tomorrow top speaks. The cascade effect. Describe how initial small market movements or information rapidly spread, triggering a chain reaction of similar buying or selling, often leading to herd behavior, bubbles or crashes. This is the cascade effect. Morning pattern we can observe 9 to 9:30 a.m. Popular Telegram channels recommends X buy Z stock buy at 500 rupees, target 550. 50,000 members see this message. What happened? Even if 10% act, 5,000 people each buying 100 shares, that is 5 lakh shares per buy order. Stock gaps up 3 to 5% at opening. Original channel operator likely already positioned 10 by 10:30 am. Institutional investors stock reverses. Case study pattern: small cap stocks. 9:40 am rupees 487. 9:15 am opens 512 rupees. There is 5% gap up on tip. 9:30 am peaks 528. There is 8.4% upward. At 11 am falls to 498 rupees. 3:30 pm closes 492 plus 1% from previous close. Retail investors who bought at 520 based on the tip now shifting to 5 to 6% losses. This is the impact of WhatsApp group, YouTube channels and Telegram channel. Result season psychology. Indian markets have quarterly result seasons when 90% companies declare in a 3-week windows. This creates unique patterns. Expectation game. Example: Reliance Industry quarter 3 result January 2025. Expectation rupees 18,500 crore. Net profit actual result 18,200 crore. 1.6% miss. Stock reaction 3:45 pm result declaration rupees 2,865. 4 pm post market 2,820 minus 1.6%. Next day opening 2,079 rupees by gap down. By 3:30 pm rupees 2,775 minus 3.1% total fall. The company had rupees 18,200 crores. Excellent, that is excellent, but fell short of expectations by 300 crores, triggering 1.2 lakh crore market cap loss. The guidance PM: Indian investors heavily react to management guidance. This example: composite pattern. A strong result but cautious outlook on BFSI spending, banking, financial services, insurance. The stock falls 500 despite beating estimates. Entire IT sector dragged down. Infosys minus 4%, ACL Tech minus 3.5%. No change current fundamentals, just future uncertainty. Budget and policy announcement impact on share market. Union Budget Day is the Super Bowl of Indian markets. Let's dissect the mechanics. Budget Day 2024. February 1, sector-wise movement. Before budget, January 31, speculation rampant in FMCG, auto, infra. Stock moves 2 to 5% on rumors alone. Budget speech 11 am February 1. Minute to minute volatility. At 11 pm, 11:15 am, FM Finance Minister announces capex boost to 11.1 lakh crores rupees. Infra stocks instant jump. L&T plus 3%. Adani Ports 4% up. 11:28 am, tax rebate for middle class announced. FMCG stocks spike. RTC 2.5% up. Hindustan Unilever 1.8% up. At 11:45 am, no major change in capital gains tax. Market dips rally. Nifty plus 250 points in 15 minutes. 12:30 pm, speech ends. Consolidation begins. By 3:30 pm close. Initial reactions partially reversed by the rumored sell the news pattern. Net Nifty gain 1.2% after being up 2.3% intraday. The policy surprise factor. RBI monetary policy example. December 2024. As it is expected, no rate change. Status quo. Actual 25 basis points repo rate cut. When the repo cut decreases, borrowing becomes cheaper for banks, leading them to lower interest rates or loans. Home, auto, personal, making them more affordable for consumers and businesses, which boost spending, investment and economic activity. Though returns on savings like FD may also fall. There is an immediate impact of this RBI monetary policy within 2 minutes of announcement. Bank Nifty 1.8% up, HDFC Bank 2.1% up, ICICI Bank 1.9% up, auto stocks 1.5% up, loan EMI become cheaper, bond yields minus 12 BPS. Putting it all together, a day in the life of an Indian stock. Let me walk you through a realistic composite day showing how these forces interact. Company Tata Motor, a random Tuesday in December 2024, previous close 920 rupees, 6:30 at 6:30 am. US market closed down 1.2% overnight, recession fears. SGX Nifty indicates 200 point gap down. Tata Motors likely to open lower. 8:45 am, Bloomberg reports strong China auto sales data. Electric vehicle stocks globally getting a boost. Tata Motors has electric vehicle exposure, helps sentiments. At 9 am, FI data from previous day released. FI sold rupees 3,200 crore negative. DI for about 800 crore rupees positive net buying. FI sold DI bought 9:50 am opening rupees 912. There is minus 8 rupees and 0.87% downgrade. Opens lower due to global cues, but less negative than expected. China auto news helped. At 9:18 am, sudden spike to 918. Algos detected buying in Jaguar Land Rover. Related stocks in EOK. Automated correlation trading kicks in at 10:15 am, dips to 910. No specific reason. Thus, low volume profit booking from standard gains. 11:30 am, CNBC TV 18 analyst gives buy call. Stock jumps to 922 in 5 minutes. Real investor pile in based on TV recommendation. At 12:45 pm, rumors on Twitter about potential JLR order from UK government. Unverified news. Stock touches 928 rupees plus 8 from open. 1:30 pm, company issues clarification. No such order received. Stocks now drop sharply to 915. There is minus 13 rupees in 10 minutes. Rumors chasers exit. Rumors chasers exit at 2 pm. Rupees weakened from 83.2 rupees to 83.35 against dollar. Positive for auto exporters like Motors. Stock recovers to 920 rupees at 2:45 pm. FI block deals detected in auto sectors. Maruti sector wise pressure. Tata Motors dipped to 916 rupees. 3:15 pm, last 15 minutes delivery based buying. DI acclimating for long term. Stock closes 924 plus 4, there is 0.43% upward. Post market stock stable at 923 after hours. Daily volume breakdown. Total traded 2.5 crore shares. Delivery percentage 42% decent. Mix of speculation and investment. Intraday range 910 to 920. Rupees 8 range 2% volatility. See how many different forces move the stock. Global cues, currency rumors, analyst calls, FI activity, sector correlation, and institutional flows. All in one day, creating that final 0.43 volume. How we have seen different forces move the stock. Global cues, currency rumors, analyst calls, FI activity, sector correlation, and institutional flows in a one day, creating the final 0.3% move upward. What this means for the Indian investor. Understanding these daily movements reveals crucial truths about Indian markets. Truth 1. Most daily movement is noise, not signal. Data point study or Nifty 50 stock shows 65% daily movements are reversed within 3 trading days. Only 15 to 20% of daily volatility correlates with company specific fundamental news. 80-85% is market microstructure, sentiments and flows. Follow the money. FI truth number 2. Follow the money. FI DI data. A smart Indian investor track daily FI DI data. NSE website 3:30 pm update. Delivery percentage on big moves. Buy bulk and block deal activity. Pattern recognition. When FI sells but DI buy more. Short term volatility 1 to 2 weeks. Good accumulation opportunity. Market eventually stabilizes. When both FI and DI sells, deeper correction ahead. Avoid catching falling knives. wait for reversal signals. Truth number 3, the Indian specific playbook. Budget day strategy. Don't change budget beneficially on the same day. Initial reactions often reverse 50-70% within a week. Buy sectors that fail despite being indirect beneficiaries. Expiry date strategy. Expect 200-300 point Nifty volatility on monthly expiry. Individual stocks near max OI often interest strikes, see unusual movements. Avoid taking fresh position on expiry day. Result season strategy. Focus on guidance. This is greater than actual numbers. Sector-wide reactions create opportunities in non-declared companies. Buy quality stock that fail on sector fear, not company-specific issues. Truth number 4. Protect yourself from manipulation. A small mid-cap safety checklist. Delivery percent consistently greater than 50%. It is good sign. Multiple institutional holders, good sign. Regular quarterly results, good sign. Sudden influx 20%, unexplained 20% moves. This is red flag. Concentrated promoter 2 to 3% increase ownership, red flag. Irregular compliance delays, result red flag. The behavior is what Rakesh Jhunjhunwala understood. The late Rakesh Jhunjhunwala, India's Warren Buffett, famously said, "Market is like a woman, always commanding, mysterious, uncertain, volatile, and exciting." His investment philosophy demonstrates understanding daily volatility. Let us see a case study from Tatan Jhunjhunwala's conviction. 2002-2003 bought Tatan around Jhunjhunwala bought Tatan around 3 to 5 rupees adjusted for splits. In 2022 sold some at 500 returns, 500 multiple returns. During this 20-year hold, Titan fell 50% at least 5 times: 2008, 2011, 2013, 2020, and 2022. Daily volatility was extreme during crisis periods. Quarterly results disappointed multiple times. FI sold heavily in several quarters. Jhunjhunwala response bought more on dips, ignored daily noise. The key side, he understood daily movements were about liquidity, FI flows, sentiment, market mood, technical factors for future options logs, not about Titan's fundamental business of selling jewelry, watches, and eyewear. Practical action from equity first viewers for equity first viewers. For day traders, 0-1 day holding. Take FIDI data daily at 3:30 p.m. Monitor global markets, US China for next day gaps. US use delivery percent to confirm genuine moves versus speculation. Avoid small caps manipulation risk high. Focus on high liquidity stocks, Nifty 50, Bank Nifty, consumables. For swing traders, 1 week to 3 months holding. Buy quality stock that fell on sector fear, not company issues. Wait for 3-day confirmation before entering. Avoid expiry weeks for entry, high volatility. Use budget policy announcement for continuing pledge. Take institutional ownership changes quarterly. For long-term investors, 1 year, 1+ year holding. Ignore daily volatility completely. Use 10% plus falls as accumulation opportunity. This is if fundamentals intact. A core strategy for long-term value creation, often referred to as buying the dip on quality assets. This approach allows investors to lower their average cost per share while increasingly exposure to companies with strong growth prospects, assuming the price drop is driven by market noise rather than deteriorating business performance. Dollar cost average through SIPs. Dollar cost averaging through a systematic investment plan is an investing strategy where you invest a fixed amount of money at regular intervals like monthly into a mutual fund, buying more units when prices are low and fewer when high, which lowers your average cost per unit, reduces market timing risk, and builds disciplined investing habits. Focus on annual reports, not daily news. Reviewed holding quarterly and not daily. Now the conclusion, dancing with Indian market volatility. Indian markets are uniquely volatile due to heavy FI dependency, 40 to 50% free float ownership. It describes a scenario where roughly 40 to 50%, 45% of a company the total outstanding shares available for public trading, while the remaining 50 to 60% are held by restricted parties like the promoters, governments, and strategic investors. Massive retail future and option participation, information gaps and remote mills, policy-driven sector rotations, investment strategy, moving capital between economic sectors like tech, banking, energy, based on anticipated impacts from government policies like infra spending, tax changes, green energy mandates, and macroeconomic shifts, inflation, interest rates, aiming to capitalize on growth cycles by shifting from underperforming to favored sectors like moving into manufacturing due to PLI production linked incentives schemes or healthcare during slowdowns. Currency sensitivity, daily price movements are like waves on ocean. The surface constantly churns with the deep currents. Fundamentals move slowly and powerfully. We can cope up and take benefit from Indian volatile markets. Understanding these all what are described by me. These are Indian markets include volatile, heavy FI dependency, massive real future option participation, information gaps and remote mills, policy driven sector rotations, currency sensitivity, daily price movements. This, but we have to depend on fundamentals, not on daily price movements. The winning mindset, companies that compound earnings at 15-20% annually. We see the stock prices reflect that, but the journey involves 30 to 50% correction during market crashes, 5 to 10% weekly volatility, daily swings that make no sense. Your job as an investor, understand the forces creating daily noise, but invest based on long-term signals. Remember what Ramesh Damani, the S investor, said, in India, you cannot handle 30% volatility, you do not deserve 30% return. Thanks for watching Viewers. If you found this deep dive valuable, smash that subscribe button, like my YouTube channel, this video, and hit the bell icon. Drop your biggest aha moment from this video in the comments. What aspect of Indian market movements confuses you most? Let us know, and I will cover in the next video. Next video is the relationship between intrinsic value and market value, the ultimate guide to smart investing. Until next time, invest wisely and stay curious.